Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1229A, and today's date is March 15th, 2017, and the title of the episode is, The Fed Just Initiated Operation Rate Increase to Begin the Collapse of the Economy. Let's get into the economic collapse financial news. Now, today the big news is that the Fed, they decided to increase the interest rate 25 basis. And we see that everyone is saying, rah, rah, the economy is fantastic. Stock market's moving up, as we can see. Everyone is believing everything the central bank says. And this is part of the illusion. And a little bit later, I'm going to explain why this is part of and why this is the collapse scenario that we're looking at right now. Now, we know the banks, they're completely insolvent. We know the stress tests, they were put into place to make everyone feel good about the banking system. That don't worry, the central bank, we're testing all the banks out in Europe and the United States, and we're going to grade them and tell you how great they are. But we know that the banks, they don't have cash on hand, they're insolvent, and we know that banks are doing whatever they possibly can to raise revenue. Look at Wells Fargo with what they were doing, opening accounts, charging individuals. And we see this with other banks. We see employees of RBC, BMO, CIBC, TD, Scotiabank. These banks across Canada, the employees are being pressured to sell products in the bank. They just want you to hit the numbers. And it doesn't matter if it benefits the individual, the customer. And the reason why is because they don't have the revenue. Here's some examples. An RBC teller from the Thunder Bay, Ontario, said, even when customers don't need or want anything, we need to upgrade their Visa card, increase their Visa limits, or get them to open a credit line. It's not what's important to our clients, she said. The bank wants more and more money, and it's leading everyone into debt. A CIBC teller said, I am expected to aggressively sell products, especially Visa. Hit those targets. Who cares if it's hurting the customers? It gets worse. Many bank employees describe pressure tactics used by managers to try to increase sales, and they continually want more and more revenue coming into the bank because the banks are insolvent. They're trying to stay afloat until they get that bail-in money, because that's where we're headed right now. We're headed to that point in time where eventually those bail-in documents, they're going to pull them out and say, don't worry, we have a solution. We saw it in Cyprus. That was the test case. They tried to do it in Greece, but things went south because people started to take their funds out of the bank. And here in the United States, we see things that are completely breaking down right now. We look at the student loan crisis. Now, according to new data that was published by the U.S. Department of Education, $137 billion of federal student loans were in default as of December of 2016. A 14% year-over-year increase. And key findings from the Consumer Federation of America says the following. Average amount owed is about $30,650 per federal student loan borrower. 1 million direct loan defaults in 2016. In 2016, 1.1 million federal direct loan borrowers defaulted. Federal law typically defines a federal student loan default as being 270 days past due. Now, what's very interesting about all of this is that these soaring defaults are continually happening despite Obama's executive action setting up income-driven repayment plans, IDRs. And these are specifically intended to lower the burden on borrowers and avoid defaults. Obama's so-called IDR plans set up caps on borrowers' monthly student loan payments at 10% of discretionary income, which is defined as earnings above 150% of the poverty level. Then, whatever principal balance is left over on the loans at their maturity date is simply forgiven, which is government speak for, the taxpayers are going to lay out that money. So any remaining balance is then forgiven after 20 or 10 or 20 years, depending on whether the borrower works in the public or private sector. So students are defaulting even though this income-driven repayment plan has been set up, where they adjust the loan to what you are making, and they adjust the payments to that. And the students still can't make the payments. This is a complete disaster. And student loan amounts continually rise. they have not fallen. They've gotten worse since 2008 because, as we know, the system that the central banks have created going back to 1913 is a debt-driven system. Now, we can see that there's inflation, which is being seen in the United States and Spain, Germany, and it's starting to move over the 2% target that the central banks want. The only thing that's not keeping up with inflation right now is wage growth. We see that real earnings have tumbled for the second straight month in a row, and they are down by 0.3%. Now, this is the first consecutive monthly drop in real wages since 2011. So real wages right now are falling, and inflation is rising. Well, this is not very good. So the Fed right now, as we know, they just raised interest rates. They're hiking into wages declining, a weak economy, and declining real wage growth. Does this seem like the right time to do this? It doesn't to me. Now, retail sales, they have decelerated. They were expecting a growth of about 0.4%, and it only came in at 0.1% in the month of February. In the month of February, we have Valentine's Day, and this wasn't even enough to push it anywhere. Now, what we're seeing is that sales have dropped in sporting goods and music stores, department stores, food service and drinking places. They all declined by negative 0.4%, by negative 1.1%, and negative 0.1%. The biggest drop came from electronics and appliance stores. They've dropped by negative 2.8%. This is awful. And department stores, well, they're imploding on themselves. The latest monthly Bank of America debit and credit card spending report shows that things may be about to get a whole lot worse for America's department store because people are not going out and they're not shopping. And we're seeing sales revenue completely drop off. It's a disaster. We see home builder confidence right now. Well, it is hitting new highs. We're almost back to where we were back prior to 2008, where home builder confidence was at its highest point. And you know what happened after that? The entire housing market completely fell apart. So here we are once again at that same point. Now, the Atlanta Fed, they keep revising the GDP. They started out at, we're going to hit 4% this year. They came down to 2.8%. They came down to 1.9%. They came down to 1.2%. And here we are at 0.9%. And remember something very important. This is the manipulated number. If you strip out the manipulation, this is in negative territory. So we start to put all this together. The Fed came out today and said we're going to be raising interest rates by 25 basis points. This is the start of the downward spiral into the collapse. Remember, going back many reports, when they raised it back in 2015 in December, they raised it once by 25 basis points. That was the signal that, yes, we're preparing to go all out and bring it down. They waited for the elections to see who was going to be elected because that was going to decide how they were going to plan this out. Once they knew Trump was in, they raised the rates in December of 2016, and they made the statement that they're going to be raising it 3 to 4 times during the year of 2017. And here we are at the first time since 2006 where they raised the rates once again for the third time. Now, what we're seeing is that the Fed just raised the rates as the Atlanta Fed came out and projected a 0.9% GDP growth. So we have contraction in retail. We see the housing market is in a bubble. Mortgage applications are going to decline even further. We see real wages are dropping. They've just raised the interest rates into a weak economy. And as we move forward into this year, most likely they will raise it once again and once again before the economy starts to fall apart. Now, the reason they're doing this very, very slowly is because they don't want to be blamed for what is about to happen. So they have to move in slowly and raise the rates. Now, if we go back in time and we look at all the different times they raised the rates, the economy came down. If we go back to the recession of 2001, we go back to the recession of 2008, we go back to before that time period, we can see that each time the economy came down. Now, we need to remember the central bank, they can bring an economy up, they can bring the economy down. And we've seen it. It's completely evident that they have the ability to do this. Because look, in 2008, when the economy came down, they were able to pump it up without the people buying houses, without the people shopping in retail, by them just creating currency out of thin air, propping up the banks, propping up the stock market, creating an illusion by manipulating the statistical numbers. They had the ability to keep the economy afloat. And we can see at this point, the deep state, well, they're ready to bring it down. Most likely, as we move into the spring and summer months, we're going to see another rate increase as the economy starts to fall apart. Now, at the point we are at now, it's going to look like, and it's going to feel like, the economy is doing fine. Now, I'm not talking about retail, I'm not talking about housing, I'm not talking about the manipulated numbers, I'm talking about the stock market. People are going to see the stock market move up now. People are going to feel like things are getting better. And in the background, things are going to be getting worse because, as we know, as rates move up, mortgage applications are declined, housing sales are going to decline, which means housing prices can't stay up. Retail is going to contract even further. GDP is going to contract even further and decline. And the system is going to start to rip itself apart. But all eyes will be on the stock market, which will continually move up. And we can see right now, they want this system to come down. Now, they have to do it slowly because they need to make sure that it stays afloat and the illusion is alive that Trump right now is going to be putting forth his economic policies because they need a scapegoat at this point. And they have one. And most likely, when the economy is coming down, they will be blaming probably another group or country where they are cyber attacking. This is why they're continually keeping the stories alive about Russia cyber attacking, Russia infiltrating our systems. They're never going to admit that it was the CIA. They're going to keep the illusion alive that, yes, they have the ability to hit our financial markets, they have the ability to steal our email accounts, they have the ability to bring down the infrastructure. They need all of this to fit into their plan. So what we're seeing right now is the illusion is going to be kept alive throughout this period of time until the spring. We'll probably see another rate increase, and then things will start to really fall apart. Now, the central bank is not going to say it's because of them. They're hoping that Trump has put forth his economic policies, and they can start blaming it on what he's doing. Because, truthfully, they just raised rates into one of the weakest manipulated economies ever. I mean, think about it. GDP is manipulated, and they're estimating it at 0.9%. Real wages are dropping. Retail is continually contracting. More and more stores are closing. Corporate defaults are on the rise. Student loan defaults are on the rise. Where is this strong? It isn't. We're heading to that time frame where they're going to bring it all down, and it's coming very soon. Get prepared. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.